Let's look at a conundrum. Investment is more male-dominated than almost any other white-collar industry, and yet there's evidence that women actually make much better investors than men. Obviously there hasn't been much evidence up until now because women haven't got to the top in investment enough to provide the data. But there's many studies now that show that this is ultimately thanks to deep differences in behavioral psychology.
Men define success very differently than women define success. Men define success very narrowly as outperforming the market. Women, however, define success quite broadly as achieving a long-term goal. And what's most interesting about that finding is that it translated not only when we looked at the data from the individual investor standpoint, but it was also equally true from a professional investor standpoint. So we looked at pension funds, investment managers, and each came about it in a very different vantage point in defining success, male versus female.
Now, of course, managing a pension fund is all about aiming for a long-term goal. And further, it's the excitement, the concentration on relative goals, trying to beat benchmarks, which has led to overcrowding and to bubbles. So this is a very important insight. It suggests that women could be instrumental in helping us to avoid investment bubbles.
In order to achieve a long-term goal, which by the way for most individual investors is very straightforward, is to comfortably retire. If you're not focused on your goal and you're fixated on outperforming an irrelevant benchmark, that like the S&P 500, or name your relative benchmark, then you're going to have a much more difficult time in achieving the long-term goal. Now, what's happening is that this is what we're calling folklore of false comfort, where men tend to gravitate towards things that are concrete, easily quantified, easily measured, and ultimately easily justified when making decisions. Women, on the contrary, more comfortable with the abstract. Long-term goals, those are abstract. Those make our brain hurt, but we're more comfortable focusing on long-term goals, even though they're abstract.
There's a further problem, and that is that men tend naturally to overconfidence. That also is exactly what leads to bubbles.
They tend to respond in a more outward fashion, so they tend to trade more as a result of that. So if you look at a study by Barber and Odine that came out in about 2001, you saw that single men trade 67% more than single women, as an example. You also have a lot more of the winner's effect at play when you're dealing with male investors versus female investors. But on top of that, you've also got cognitive and behavioral factors at work as well. So from a cognitive perspective, that's where you really see the overconfidence at work. And again, what overconfidence does is it tells you that every idea you have is a good one. So whether you're buying or selling, you believe you're right.
Now, does that mean that we should evict all the men from trading and dealing rooms? No.
Are men together with women better investors? And the answer to that is yes. If you look at high-performing teams, irrespective of discipline, it's not the high IQ performing team or those teams with high financial levels of literacy that outperform those that don't. It's the teams that are most diversified, because what we really need is diversity of thought.
Well, I don't think that anyone would argue that you want to have 100% of either gender, because then you're just exchanging one set of behavioral biases for another set of behavioral biases.
We are quite close to 100%.
We are pretty close to 100%. We're at about 95% right now. But going to 100% women would, like I said, mean that you are not diversified from a behavioral or from a cognitive point of view, and therefore that would not be optimal either. So I think what we should be looking to do is to add this type of cognitive and behavioral diversification and alpha to portfolios, either through investing with some percentage of women-run funds, or from looking to firms that have a mix of male and females at the investing helm.
Now, of course, all of this does leave unanswered the central question of why so few women go into investing. Now, I spoke to one female hedge fund manager who said that in many ways it was simply cultural.
My name is Jordan Belfort. The year I turned 26, I made $49 million, which really pissed me off because it was $3 shy of $1 million a week.
Bright young women heading to university can imagine themselves in a law court or in an operating theatre, but they can't imagine themselves in a large trading room full of young men shouting at each other. And that's the image of Wall Street and of investing that we've all had from the movie Wall Street back in the 80s through to The Wolf of Wall Street much more recently. However, there are perhaps some signs for hope. That culture is steadily changing, and also maybe Wall Street will realize that it's in its own economic interests to bring in more women. If Wall Street realizes there is money in this, there's every chance it could happen.
I do agree with you that Wall Street is definitely very profit-driven. It's definitely driven and motivated by looking to find that X factor and generate those extra returns. And so I do believe that alone, that as that recognition that this is something that is a sustainable competitive advantage, it's not something that exists just because you have so few women in the industry. It's not something that's going to go away, that these are very ingrained behavior, that it's very ingrained way of thinking about probabilities and risk. It's a very ingrained, I mean, you can't get rid of your biology anytime soon. So it seems to me that as people accept that this is something that's sustainable, that they will seek it out more and there will be more women in the industry.